Assalamu alaikum. Welcome to lecture 8 of ATX. So from lecture 1 to 7, I have finished the income tax portion of ATX. Now I'll be moving on to the second type of tax from lecture 8 to 11. We'll be covering capital gain tax, CGT, the short form of capital gain tax. So in this first lecture of capital gain tax, we'll be studying how to compute CGT and a new tax that is new for ATX that was not explained to you in tax is stamp duty land tax. Now, so in this we are going to focus on basic capital gain tax rule, how do you pay it, and on the death of an individual how would be the CGT. This section is new. Wherever I've mentioned new in red, it's only for ATX, it's not there for tax. Then when you are transferring the asset into a trust, that is also capital gain nature. That is also new. And stamp duty land tax. So these three are new, and finally the summary. Now starting with the overview. So when we dispose capital assets, see in the earlier 1 to 7, we studied all various types of income, right? We studied self-employment income, we studied employment income, all the types of taxable benefit, exempt benefit income, taxable income, exempt income. Then we studied property and investment income. Then we studied pension, which were taxed at savings, non-savings, or at dividend rate at 20, 40, 45% for savings and non-savings, and for dividend 7.5 and 33.75 and like that. Now, when we are moving on to the second type of tax, like from lecture 8 to 11, capital gain tax, this does not come under income tax. This is separate and different tax rates are used for it. So this is the nature of capital gain taxes when you are disposing, when you are selling any type of capital assets, which is in nature, it is a capital type of assets. Okay, that asset is a capital type of asset. We get a gain. It's not an income. Whatever we get when we sell that asset, a profit or a loss, it's known as a gain. On that gain, we are taxed. And that is known as capital gain tax. CGT. So I'll be referring to CGT hereafter for capital gain tax. Then another type when you're disposing capital asset, new tax, stamp duty land tax. CGT has been taught to you in tax. This is just a revision for ATX level students, and stamp duty land tax is new for both tax and ATX. Now, basic CGT rules, gifts on death and gifts into trust. So first starting with the scope of CGT. Remember, any disposal, it needs to be a chargeable, by the way. How we have exempt income and taxable income, here also we have disposal which are chargeable and not chargeable. Only chargeable disposal by a chargeable person, okay, of a chargeable asset will be charged to capital gain tax. How in income tax we have taxable, it needs to be, income needs to be taxable by a taxable person in a taxable year, right? In a tax year is charged to income tax. Here it is capital gain tax. Now, who are chargeable person? Any individual, any company, any business partner are chargeable. Very easy. So when we are, remember, capital gain tax we have from the point of company also. When we study companies, that is corporation tax, there also we are going to study CGT. But in this lecture, our focus is disposals made by individuals, not company. We haven't arrived to company yet. We are still in the individual level. Okay. But remember, these rules you will need when we go to the company. Very important, because there also we have some differences, some similarities. What is the basis of assessment? Basis is under self-assessment, and it is based on the actual disposal of capital assets between 6th April to 5th April. Isn't this the tax year in your income tax? Yes. Your tax year runs for individuals 6th April to 5th April. Even for capital CGT, it is taxed during this period when you're disposing any capital asset during this period. Okay, very simple. Coming to disposal, which are exempt, disposal which are chargeable. Very important. Why? In your ATX exam, you might be given a list of disposal. Some might be exempt, some might be chargeable. Don't put all the disposal add and put a tax on it? No, some are exempt. So first we'll go through the chargeable list. When you are selling or when you are gifting also, suppose you are not selling, you are gifting a part or whole of an asset, it's a chargeable disposal. Next, when you are exchanging an asset, disposal. When there's a loss or a total destruction of an asset, it's chargeable. Receipts of a capital sum derived from an asset. For example, you are getting a compensation received for a damage to an asset. For example, compensation received from insurance. It's a chargeable disposal. On that also you have to pay tax. When you're receiving the surrender of rights to an asset, receipts for the surrender of rights to an asset under lease, chargeable. Coming to exempt. Okay. When you are disposing as a result of a death of an individual, that is exempt. When you are gifting to charity, exempt. So these two are exempt, rest all are chargeable. Now, this are disposal, okay? Do not get confused between disposal and asset. Now we are going through the list of chargeable asset and exempt asset. Chargeable asset, we have freehold land and buildings, goodwill, short lease, long lease, unquoted shares, quoted shares, unit trust, chattables, chattels bought and sold greater than 6,000. Because if it's less than 6,000, it is exempt. What are chattels? Chattels are tangible and movable assets. You can touch them, you can move them, like furniture, plant and machinery. Okay. Then exempt assets, motor vehicles, main residence, where the owners are occupying. Because for that we have another rule. We can exempt that tax. There is a rule for it. It's an exempt asset. Cash. Remember, not any residence. It has to be a main residence. Main residence only one, where you are occupying that residence. Only that is exempt asset. Not any other property that you have. Other residential property if you have, that is not exempt. Cash, exempt asset. Vesting chattels. What is vesting chattel? Like race horses and grey horse, they are exempt. Chattels bought and sold less than 6,000. Exempt. Investments within ISA, exempt. This was exempt in income tax also. Qualifying corporate bonds, exempt. Gift aged security, exempt. National savings certificate, exempt. Shares in VCT, exempt. Shares in VCT, we are going to study this again later. Okay. Under the schemes, investment schemes. We have covered it, right? In income tax, yes. Now, endowment policy proceed, exempt. Foreign currency for private use, exempt. Receivable, exempt. Trading inventory, exempt. Prices and betting winnings, exempt. Remember, in your ATX, you will not be given this list of exempt assets, maybe one or two exempt assets, but most of it would be chargeable only. Otherwise, what is the purpose if they give you everything exempt? Then you don't have to, pay any tax, no? No tax calculation is required, so it's not worth it. They will give you one or two exempt assets out of this list. Okay, now date of disposal. When you determine the date of disposal is very important because it determines in which tax year you have to pay the tax. So if it's a lifetime transfer, normally there are three. One is normal, one is conditional contract, one is transfers on death. If it's normally, then date of the contract to transfer the asset. Okay, the date of the disposal would be the date of the contract when you are telling that you will transfer the asset. It is not the actual date of transfer, right? Whatever the date is there in that agreement that says that you are going to transfer the asset on this date, that is the date of disposal, not when you are actually disposing it. And when you are transferring it on a conditional contract, date of disposal will be when all the conditions are satisfied. Transfers on death. Remember, it is the date of the death of the individual when the transfers are on death, but there will be no capital gain tax payable on death. Now let us do question. Illustration 1. So here you have to decide the date of disposal. Okay. And you have to state the tax year in which gains will be taxed. So this you have to decide. Now, this is about selling an investment property. Contracts were exchanged on this date and there was an intention to complete it by 25th March 2024, and the contract was conditional on the planning permission being obtained. The permission was granted by 29 March 2024, but completion took place on 8th April 24. That falls in the next tax year, right? Tell me in which tax year it will be taxed. They will be taxed in 23, 24. Why? Because this date falls in this tax year, 6th April to 5th April, right? Remember, this completion date, this one is not relevant because this sale agreement was based on a condition. It's a conditional contract. So the moment the condition are satisfied, that will be the date of disposal. And the condition was satisfied on this date. That's why it falls in this tax year. Okay. So now, after deciding on the date of disposal, the next is how do you compute CGT? Now, step 1. You need to calculate. Remember, in your exam, don't write step 1, 2, 3. Okay, you should know how to calculate, which should be step 1, 2, 3. This comes with practice. Do lots and lots of questions on computation of CGT. Automatically steps will come to you. 1, 2, 3, 4. Okay, step 1. You need to calculate a chargeable gain, or it could be an allowable loss when you're disposing the chargeable asset. Each chargeable asset separately you have to calculate the gain or a loss. Then you have to add all. Okay, let's say you have 5 chargeable assets. Okay, so in 5 you will see you are having a gain or a loss. In some you might be having gain, in some you might be having loss, or maybe you might be having loss in all, which is very unlikely, or you might be having gain in all. So add all the 5 assets, chargeable gain and allowable loss together. You will get one gain or a one loss. From that, see, you have to deduct the reliefs, like how we have income tax reliefs, personal allowance. Here also we have some reliefs for CGT. Don't worry, CGT relief itself is a big huge lecture. We have lecture 11, in fact, is on all CGT reliefs only. It's a big huge lecture. Okay, so you have to see which CGT relief is available based on the condition scenario given to you. Okay, you have to consider the availability of any CGT reliefs, because that release you have to deduct from your gain. Step 3. After you deduct CGT release from your chargeable gain, step 1 minus step 2, you will come to step 3, net chargeable gain. Okay, automatically they will it's most likely that you are going to have a net chargeable gain. So the tax will be paid, right? That is capital gain less allowable losses. You'll be having some losses brought forward or current year loss that you have to deduct. Deduct the annual exempt amount. Here we don't have personal allowance. For income tax, we have personal allowance 12,570. When it comes to CGT, we have annual exempt amount. Annual exempt amount for this year is 3,000. With brought forward, always we are bringing it forward from the previous year 3,000. So total annual exempt amount would be always 6,000 in your calculation. Okay, 3,000 of this tax year, 3,000 brought forward. So 6,000. Keep 6,000 as your annual exempt amount. Step 5. After deducting AEA, annual exempt amount, we deduct any capital losses brought forward and get the taxable gain. Whatever the gain, then on that we pay tax. Like how we have taxable income, here we have taxable gain. This is the difference. Then we calculate CGT on that gain, taxable gain. Okay. Remember the rates of CGT. I will discuss that later. Okay. In this lecture only it will be there. Are different to income tax rate. Okay. And it's more easier also in CGT. Then one more thing you have to deduct. When you are making any payment on account for UK residential property disposal. Okay, deduct payment on account for UK residential property disposal to calculate CGT payable. Remember, if you are having any UK residential property disposal, that separately you have to deduct. And then you have to calculate CGT liability. Okay. Why we have to deduct it separately? We don't know. That's the rule. Okay. Because maybe they feel that UK residential property disposal are very material, they need to be kept separate from the other chargeable gain, because mostly people would like to manipulate in this area, right? When they are UK resident and they are having a residential property when they are disposing it. Now, so these are the 7 steps. Coming to the pro forma. This is the pro forma. Net chargeable gain, we deduct annual exempt amount 6,000, less capital loss brought forward, we get a taxable gain. And then on that, based on rate, appropriate rate, we get CGT liability. Then we deduct payment on account and get the CGT payable. Okay. Now, calculation of the individual chargeable gain or allowable loss. That was general, basic. Now individually. So first, consideration. That means proceed. We have notes for some of them. Wherever I mentioned note, please make a mark of it. In next slide, I will explain you what it means. The notes will be given. Note 1, 2, 3. So first is consideration. We have a note for it. Then any incidental cost of sale we deduct from the consideration. It's under note 2. Then we get the net disposal proceed. Then any allowable expenditure we deduct. Accusation cost and incidental cost of accusation. For accusation cost, it's under note 3. Then any enhancement, when you are enhancing the expenditure, remember it has to be in this tax year, before the tax year starts, right? When you're acquiring, during that tax year, you have to enhance. Then it will be allowable expenditure. We get a gain or a loss. Now, these are the notes. 1. These are the consideration. Normally, whatever the disposal proceed we take, that is consideration. Actually, that at the proceed that is actually received, less any cost. Okay. Remember, this is for sale to an unconnected person. If it's a connected person, we have different rules. Because normally to connected person, like related parties, we try to sell them at a discount, right? Lesser than the normal disposal proceed. And when it's a market value for gifts, so market value for gifts and sales to a connected person. If it's a connected person, we look at the market value. And if it's a proceed to an unconnected, disposal to an unconnected person, whatever the disposal proceed you have actually received. That is your consideration. And when you're disposing a building or a structure where SBAS has been claimed. SBA I have explained to you in the previous lectures, where I have explained you capital allowance. In my capital allowance lecture, SBS was there, structure business allowance. For a business, for a building and a structure, we have different types of allowance known as structure business allowance, SBA. We don't have capital allowance for that. Capital allowance is for plant and machinery, cars and like that, okay? So when we are disposing any building or a structure on which SBS has been claimed, that SBA you can add with the consideration. Next, note 2, incidental cost of sales and accusation. Legal expenses, valuation fee, state agent fee, auctioneer's fee, because these are needed for you to sell and also to acquire. So you can deduct advertising cost, stamp duty on shares and stamp duty land tax on land and buildings you can deduct. Note 3, acquisition cost, actual cost when you're purchasing an asset. Market value when the asset was gifted. And probate value when you are taking it at the donor's death. Donor means the person who is donating or giving it to you, or from whom you are inheriting the asset. It is known as donor. And if you are inheriting, let's say your father is giving a building to you. Your father is the donor, you are the donee. This will be explained to you in inheritance tax. Okay. So for that, the acquisition cost would be at probate value. That means you are acquiring it at a probate value. When does this take place? At the death of the donor's death, if you are inheriting the asset. So remember what cost you have to take based on the condition. If you are purchasing an asset, actual cost. When you are taking an asset, like when you are gifted an asset, market value. And when it's on the death of the donor, probate value. What is this probate value? This will be explained to you in inheritance tax later on. Now coming to capital losses. First we'll deal with current year capital loss. Any capital loss in the current tax year will be set off against the chargeable gain in the same tax year to the maximum possible extent. Remember, you cannot restrict that only up to this much only you will deduct capital loss from chargeable gain. That flexibility is not there. That means if you are deducting capital loss, you might waste some or entire annual exempt amount. Possible. Any unreaped capital losses, after that, if you are having any capital loss, you can bring it forward and set against gains in future years. It has to be gains, not income. Capital loss against capital gain only. Now, for brought forward capital losses, okay, brought forward losses are set against chargeable gain. But remember, brought forward losses are dealt after you deduct your current year losses and annual exempt amount. Because annual exempt amount, you can't bring it forward. It is wasted if you don't utilize this year. But brought forward losses, indefinitely you can carry it forward. And unused loss is then carried forward. Negligible value claims. Okay, let's say your asset becomes negligible for whatever reason. Then owner may claim a relief. How? Owner is then treated as having disposed of and immediately reacquire the asset at its negligible value. So if this happens, it crystallizes a capital loss. Crystallizes means it increases the capital loss. So the deemed disposal is treated as occurring at the date of claim or up to 2 years before the start of the tax in which the claim was made. We'll do questions on this negligible value claim for you to understand the calculation part. Now, remember, the backdating of the capital loss applies only if the asset was actually of negligible value at both the date of the claim and the earlier date. Then only you can bring forward the take back the capital loss. Otherwise, you can't do that. Asset has to be actually negligible both on the date of the claim and the earlier date. Now, annual exempt amount, it is 6,000. Now, okay, I'm so sorry. I was telling that 3,000 brought forward and like that. No, it's 6,000 for this year, 2023-24 annual exempt amount. Okay. Now, so I just kind of got confused with the inheritance tax. The amount that I was telling 3,000 this year 3,000 brought forward was from inheritance tax. So this is a very common mistake any one of you could do. You could get confused between different types of taxes with the rates. Okay, because inheritance tax has a different amount, capital gain tax has a different amount, so it's very easy. Mostly capital gain tax and inheritance tax, very highly likely for you to get confused between the two, mixed. So don't do this mistake. Okay, so for capital gain tax I would correct my mistake. Annual exempt amount is 6,000 for this year, no brought forward and nothing. It is entirely 6,000. That brought forward concept is in inheritance tax. Okay, so yeah. Now, if AEA, like personal allowance, not utilized in the current year, it is wasted. Now, remember the rate of CGT. This is depending on the individual taxable income, total taxable income after deduction of personal allowance. Why? Because we offer, when we have income and gains, an individual could have both income and gains, right? First, the basic rate, higher rate, additional rate will be decided based on the income. First, we'll always see the taxable income. That band will be first utilized by the income, then by the gains. Okay. So let's say you have 70,000 of income. You are already a higher rate individual, higher rate taxpayer. So your CGT would be taxed at 20 or 28%, depending on whether it's a residential or non-residential, at a higher rate, not a lower rate. Okay. And also the type of asset being disposed of, if it's a residential or non-residential. Now, taxable gain are always taxed after taxable income. So do not combine income and gains in one computation. Keep income separate, keep gain separate. Generally, when your taxable income and gain are less than the upper limit of the basic rate band, CGT will be taxed at 10%. Let's say you have 30,000. Your taxable income is 20,000. Your gain is 10,000. Together it's 30,000, less than 37,700, the basic rate band. So your CGT would be taxed at 10%. Lower limit is 10% of CGT. And if you are extending that band, if you are higher than the basic rate band, the moment you exit the basic rate band, any gain, it would be taxed at 20%. CGT would be taxed at 20%. So lower rate for CGT is 10, higher rate is 20. We don't have three levels like how we have for income tax based on income. Okay, this is easier. If Remember, this basic rate ban could be extended. How we have extended it for income tax by having personal pension contribution and gifted donation. Same way, if you're having any gifted donation or if you're having any personal pension contribution, by the way, personal pension contribution I have covered in my previous lecture, lecture 7. Please go back and watch it in case you have missed it out. You can always extend your basic rate ban by the gross amount of contribution. So when we decide the rate for CGT, that extended basic rate ban will be used. And any unused income tax personal allowance, remember, you might be having personal allowance from 12,570, some of it might be unused. That unused personal allowance you cannot use to reduce your taxable gain. Keep it separate. Personal allowance can only be deducted from income, not gains. That is wasted. Now, rate of CGT. If it's a residential property, what happens? Residential property is where a person normally lives, reside. Commercial property is mostly used for a business, right? So if it's a residential, if it's not if it's a commercial, rates will be 10 and 20%. If it falls in the basic rate band, 10%, in excess of basic rate, 20%. If it's a residential property, lower rate is 18%, higher rate is 28%. Remember these rates. 10, 20, 18, 28. And the difference between the both are 10%. 10 minus 20, 18 minus 28. Difference is 10% only. Now, so what about the taxpayer's main residence property where where the taxpayer is actually residing? What about it? Remember, the taxpayer's home will be exempt from CGT. Why? Because there's a relief for it. This relief I'll be covering it in lecture 11. All the CGT reliefs are in lecture 11. Under the private residence relief rule. Okay? But remember, when you are disposing a residential property, the entire gain might not be exempt. Right? Let's say if it's an investment property which is let out. Okay? So example, on an investment property which is let out, it will be taxed at the higher rate. So other residential property might be taxed at 18 and 28. Only your private residence, where the tax, which is the taxpayer's home, main home, only that one will get the relief and will be exempted from CGT. Other residential property would be taxed at 18 or 28. Now, taxpayers can offset their annual exempt amount also, capital losses also. Again, whatever gain they choose. So from any gains they can deduct. Objective has to be that they have to maximize the reliefs. So that means there are two types of gain: commercial gain, residential property gain. If it's a residential property gain, always deduct your losses or your annual exempt amount from residential property gain first. Why? Because residential property gain are taxed at a higher rate than commercial property gains. It is at 18 and 28. Highest is 28. But if it's a commercial, highest is 20. That's why. And unused basic rate band, how you are going to utilize it against property, commercial property or residential property. Here also again taxpayer can choose whichever way they want. Okay, remember, here planning will not help you about using the unused basic rate band. Why? Because your tax saving will be same against whichever gain you utilize your basic rate band. Why? Because if you're like if you are a, let's say, residential 2818 and non-residential, if you're switching gains from 20 to 10, that means from commercial, from higher to lower you are falling 20 to 10, or at a residential from higher to basic rate you are going down 28 to 18. The difference is 10%, whether it's 28 to 18 or 20 to 10, difference is 10%. It is giving the same result, so you're not actually going to save any tax. That's why for unused basic rate band, when you want to offset against residential or commercial, you can choose anyone, anything. tax saving will be same. Now, when you're disposing a UK residential property, remember, you have to report this to HMRC within 60 days of completion, and you have to pay the relevant CGT on time. At the same time, you have to pay. A UK land return is submitted through an online system and also with the payment of CGT. You don't need to submit a UK land return if there is no CGT due. If this would be the case, remember, this would be the case where, let's say, the gain is covered by your private residence relief, then there's no CGT. Then you don't have to give any UK land return form to HMRC because you don't have any CGT due. Or your gain is less than annual exempt amount, less than 6,000, or the property was disposed of at a loss, then you will not have any CGT due. Calculation of CGT payment on account. The rate of CGT would be determined based on the individual's income at the point of disposal. That means we'll estimate how much of the basic rate band will be remaining. And any brought forward loss or any current year capital loss will be realized before the UK residential property disposal may be offset against the gain when calculating the tax due through the online system. First, we deduct brought forward loss and current year loss before we deduct UK residential property disposal. This you need to remember. Now, remember the calculation of payment on accounts where there is more than one residential property disposal will not be asked in ATX. Thank God. Now, inclusion in final self-assessment tax return. What do you have to include in that tax return? All the disposal that you have made during the tax year. Also your UK residential property disposal you have to include in your final tax return. Then deduct CGT payment on account from CGT liability to reach the final CGT payable. If the repayment is due, you can claim this when the self-assessment tax return for the tax year is submitted. And when is the due date for CGT? There are 3 dates when it's a payment on account: 31st Jan, 31st July, and 31st Jan again. So the due is 31st Jan during the tax year, 31st July following the end of the tax year. Remember, payment on account for CGT, there are 3 dates: 31st Jan, 31st July, and 31st Jan again. But there is also a normal self-assessment payment on account also. This also falls on 31st Jan during the tax year, 31st July following the end of the tax year. These are not the same as payment on account of CGT. They are separate. Okay. So your normal self-assessment payment on account are due by 31st Jan and 31st July following the end of the tax year. This has nothing to do with the payment on account of CGT. Now, let's go through the summary before we do a question on this. So CGT, what is the scope of tax and the computation? Chargeable disposed, chargeable asset by chargeable person. And calculate gain or loss. This is the basic pro forma. Proceed minus cost is your gain. Then calculate gain in the tax year. Take the total of all chargeable gain and deduct capital loss and annual exempt amount. Capital loss first against current year, then brought forward losses. Remember, offset only after annual exempt amount. Then calculate tax payable. Non-residential at 10 and 20, residential at 18 and 28%. Now let us do a question. Test your understanding 1. So here we have to calculate the CGT payable. We have been given some commercial and residential property with the income, capital loss brought forward. So here we'll see. For residential, the tax paid was this much. And capital losses brought forward was 22. And source of income is only trading income of 40, 20, 70. Now, so let's see. First one is a residential property. Which one was 650,000. Okay, she sold it for 650,000. She acquired the building for 80, extended it at a cost of 30,000. Then there's a painting. on 20 on 1st August for 20,000. So she sold it for 20,000, incurring an auctioneer's fee of 10%, acquired the painting for 35,000. A painting, another painting she sold for 80, it has been purchased for 7,000. Very easy question. Only thing is you have to follow the pro forma, the correct rates of CGT, and do the CGT this thing. Remember, when we are doing CGT calculation, like how for income tax we divide under three categories: savings, non-savings, dividend. Here we do residential and non-residential property. Why? Because the tax rates are different. So let's quickly do that. Okay. Now, commercial property CP, residential property RP, and the total. So first one is the residential property. Remember, we have to take the proceed first and deduct the cost. So it was sold for 650,000, the first one. Then the cost was 80,000. Remember what cost we can take? 80,000, and extended it at a cost of 30,000. All this cost enhancement and acquired the building was done before this year, before this tax year. You have acquired it at 2008 and extended at 2010. Both are before the current tax year when you are selling the residential. So we can deduct both the cost, 80 and 30,000. Extended cost. Okay. So it would be 540,000. We'll go in the residential property. Total is 540,000. Now the painting comes under commercial property. Painting also. We have sold one painting for 80,000 and the cost was 7,000. You see? Here it is 80, here it is 7. Another painting, we sold it for 20. Cost we have incurred is 10% of the fees. And we have acquired it for 35,000. Okay. So, painting 1. Painting 2. So this is 73,000. We'll write here. 73,000. Painting 2. We have sold it for 20,000. Auctioneer's fees 10% of 20,000, which is 2,000, and we have bought it for 35,000. Remember, now there is a cost. It's a loss because the loss is 17,000. It's not a gain. So because this is a loss, 17,000 capital loss. Remember, capital loss will deduct from which gain? CP or RP? RP, residential property, because this we pay higher tax. So we'll deduct the 17,000 from residential property. Here we'll put 17,000 and the total is 17,000. Now we'll do the total. Commercial property would be 73,000. Residential will be reduced to 523,000 because we have deducted 17,000 loss, capital loss, and 596,000. Deduct your annual exempt amount. Don't forget this. 6,000. We'll take it from residential. Once again. And here also 6,000. And capital loss brought forward. This 22,000. Again we'll deduct from residential. Total also 22,000. So taxable gain TG 73,000 in commercial, 495 in residential, and together 568,000. So now we'll tax them because they are CGT. Remember, to decide we have to see the other income. His income was 40, 20, 70, isn't it? But remember, from this trading income, do not forget to deduct personal allowance. When you come to CGT, don't forget your income tax rule. This is the hard challenge in ATX. We have it's a what do I say? Interaction of multi taxes. On one side we have CGT, corporation tax, inheritance tax, VAT, capital income tax. All the 5 types of taxes will be coming in one question. There will be a question like that also. Unlike in taxation where we are only asked on a particular type of tax, one area. Okay. So what was the income given to you? 40, 20, 70. From here we did our personal allowance 12,570. Personal allowance from trading income. TI. Which would be, this is 27,700. So this 27,700 is less than basic rate band. How much? If you see the basic rate band, the difference is 10,000. Still 10,000 of basic rate band is remaining, which could be taxed at gain. Okay. So this basic rate band you can take against that 10%, you can take against this also, this also. Remember, we just now saw tax saving will be same. So basic rate 10,000 at 10%. Why lower it is 10%? For residential, it would have been at 18%. So let's take at a lower tax, 1,000. Then higher rate. How much? Remember, out of the 73, 10,000 is at 10, so 63,000 would be taxed at 20%. 12,600. Now we have 495. Entire amount would be taxed at 28% because it's a higher rate. 138,600. Add all, it's 152,200. Do not forget to deduct the tax that you have paid through online system, which is this 142,360. This has been paid in respect of residential property, so we'll deduct that. Any tax paid you have to deduct 142,360. So we'll be living with 9,840. This is the amount of CGT payable. Okay. CGT is normally payable. So now we are coming to payment of CGT. Under self-assessment, same like income tax. In one payment, along with the balancing payment of income tax. One payment will be having it with the balancing payment of income tax for CGT, except for the disposal of UK residential property. So CGT are payable by 31st Jan 2025 for the tax year 23-24. That means 31st Jan following the end of the tax year. When is the end of the tax year? 5th April 24. 31st Jan after that would be 31st Jan 25. Remember the dates. Now, moving on to the third part of this lecture, CGT on the death of an individual. We know that any transfers on death are exempt disposal. Okay. Now, and CGT are a lifetime tax. Forever you have to pay the CGT tax. It's not, there's a non-stop to it. So when you're dying, it is exempt. And CGT consequences of death: no capital gain or an allowable loss. Beneficiaries who inherit the asset from the deceased, they are acquiring the asset. It is deemed that they are acquiring the asset. At what value? Probate value. It is known as probate value. How do you calculate this probate value? Your base cost will be equivalent to the market value of the asset at the date of the death. That means, what is the market value of that asset at the date of death? That would be the probate value. Regardless of the day they actually receive the asset, doesn't matter when they actually receive the asset. The date the person died, that is on that date you have to take the market value of the asset. And that means that is the date on which you have acquired the asset. And it is very common that asset might appreciate in value, right? But that appreciation in value is not taken into account. Because it's possible that from the accusation of that capital asset till the date of the death, that increment in the capital value, however much that capital value increase, it will not be liable to CGT. But there are inheritance tax implications when an individual dies. Inheritance tax will be studying, that is the our next type of tax. Third tax would be inheritance tax. First was income tax, now capital gain tax, third inheritance tax. That will start from lecture 12. Now let us do a question. Illustration 2. Here we have to explain the CGT consequences on a death. So asset was bought for 300 and when he died asset was worth 1 million. Asset is left to his son and it was given on 21st March. Asset was sold for 1.2 million on 16 March 2025. So tell me, on the death what would happen? There's an increment from 300 to 1 million. So this jump from 300 to 1 million, it is exempt from CGT. Number 1. This you have to write. Next, at what cost Gorka is deemed to acquire this asset? 1 million, because this is the value of the asset on the date of the death. So he will acquire the asset on 1 million on 10th December 2023. Always write the date next to the cost. Okay, very important. Date is very important. Next, when did he actually receive the asset? 24th March 2024. Doesn't matter. Actual date, it's not relevant. Now, when Gorka is selling this asset, what happens? Then it would be a chargeable gain. That time it's a chargeable gain. How much? He acquired it at 1 million. Now he's selling it for 1.2 million. So 1.2 minus 1 would be 0.2 million. So 200,000. There would be a chargeable gain of 200,000. So now we are moving on to valuation of quoted shares on death. Here, the probate value of quoted share is whatever the valuation on death. If it's a quoted share, remember this is the valuation technique and this you have to remember. This is different to when it is for inheritance tax purpose. Okay, in IST is a different rule, CGT is a different rule. Here it would be taken, the valuation on the death would be taken as lower of, quarter up or average marked bargain method using the IST valuation rules. When a valuation was not obtained on death, then you have to use the mid price using the CGT valuation rules. Now, this will be the case where the value of the asset falls below the inheritance tax threshold and no IST was payable. Okay, the second method, no IST is payable and state falls below the inheritance tax threshold, then we use the mid price using CGT valuation rules. That means there is no valuation that was obtained on death. Usually, under inheritance tax rule, we obtain a value on death. We have to take that. This is for quoted shares only. Now, so when we go to IST, we'll explain you the rules, how it works. Tax planning. Yes, it's possible that an individual could change the term of their will so that it's tax advantageous by entering it into deed of variation. Remember, when you do that, when you change your will, it has both CGT and inheritance tax consequences. Now, when you are dying, the capital loss at that year, what happens? Losses in excess of gain arising in the tax year of death, you can carry it back 3 tax years on a LIFO basis. That means reason year first, then behind, and you can set it against the remaining net gains, not income, net gains in those years. When you're carrying it back, remember that offset is only after deducting annual exempt amount. So when you are carrying back the losses, it's possible sometimes you might be given repayment of CGT by the HMRC. So that repayment that you get from HMRC, this also will be an asset at the date of individual's death. And it has to be included in the individual's death state for inheritance tax purpose. I know it's too complicated. Like you have been given a repayment of CGT by in HMRC, again you have to pay tax on that. I know it's not fair, but I mean, it's their rule, right? It's the rule of UK. They have invented this rule. They want to tax everything. So even if they're giving you a repayment of CGT, but under inheritance tax, you have to pay back that tax. So there is not much of a benefit, even if you're getting a repayment, right? But anyway, now when you're transferring an ISA on death, what happens? It's possible. On death, the ISA allowance, you can transfer it to the surviving spouse. Okay, so as a result, what happens? Remember, ISS are exempt from both income tax and capital gain tax. So this tax benefit would be retained by the surviving spouse also. Now, when you're transferring the asset into a trust, what happens? There are two types of transactions. One, you are gifting the asset into a trust during the lifetime of the donor or on death. So if it happens, it has CGT consequences. If it's a lifetime gift, it's a chargeable disposal at full market value. And there is a gift holdover relief that is available because there is an immediate charge to inheritance tax. What is gift holdover relief? It is explained in detail in my lecture 11 under CGT reliefs. But here let me explain it to you very briefly. Gift holdover relief means temporarily you are deferring the tax, you are delaying the tax. Okay? You are deferring the gain. We are not exempting the tax, but for time being, we are delaying the tax. We are not paying the CGT right now, rather we'll be paying it in the future disposal. We are holding the gain right now, freezing the gain. And this happens when you are gifting. It's on a gift. It is known as gift holdover relief. How it works, how and all, everything will be explained in lecture 11. Now, when the gift is on the death of the donor, no gain or loss. And the trustees will acquire the assets at profit value. Now, the last part of this lecture, stamp duty land tax. Two types of stamp taxes are there. Stamp duty and stamp duty land tax. Stamp duty, I will explain you when we go through the shares, when we are transferring shares and other securities. Stamp duty land tax will be explained in this lecture. This is when you are transferring UK land and property. Okay, we have to pay. When we are purchasing UK land and property, we have to pay stamp duty land tax. Okay, unless the transaction is specifically exempt. If the transaction is specifically exempt, you don't have to pay SDLT. This is payable by the purchaser on the transfer of the land and property, lease premium, and also rent paid under leases in England and Northern Ireland based on the value of the property transferred and the type of property. Now, this is charged on non-residential properties like this. Okay, remember this land and property are non-residential. Okay, if the value is 150,000 or less, the charge is 0%. If it's 150,000, 1 to 250, 2%. Beyond 250,000, 5%. Okay. So we have to see under which band the value is falling. Based on that only we'll tax. Remember, SDLT that are charged at residential property are different rates, but this is not asked in ATX. So you only have to study this 3%, 0, 2 and 5% for non-residential property. Moving on to consideration paid. So the consideration is any amount or money's worth provided by the purchaser. Maybe you're not paying in cash, but something that you can that is an equivalent to this much of worth, you can take as a consideration. Now, where the consideration is unascertainable, what happens? Then you have to estimate it. Where you can ascertain a value to it, you have to estimate. And any changes to that consideration, you have to notify to HMRC. Maybe because of some future event, your consideration is changing. You have to notify this to HMRC. And accordingly, if you are paying less before, and because of the changes in condition, I have to pay more, so you have to pay that duty to HMRC, or where you have paid more before, whereas now you have to pay less, HMRC will repay the duty to you. Now, exemption from stamp duty land tax. If the transfer is exempt, you don't have to pay this. These are the main exempt transfer. You have to know this transfers. Gifts. If it's a gift, that means there are no, provided no consideration is given. Sometimes in gift also we give a consideration. But if it's totally exempt, like no consideration, just a gift, no SDLT. And if it's a divorce arrangement, you are getting it because of a divorce arrangement. Let's take alimony, it's exempt. Variation of a will, exempt. When you're transferring an asset between the member of 75% group of company, exempt. This 75% group of company will study in company tax. That is corporation tax when we are studying, okay? Now, so transfers between 75% company, there is no charge to stamp duty or stamp duty land tax when assets are transferred between this group. Two companies are in a group where one is a 75% subsidiary of the other, or they both are 75% subsidiary of a third company. Remember, the relief is not available at the time the assets are transferred. When there are arrangements that says the purchasing company is about to leave the group, that time there will be no relief. So when the assets are transferred, you have to be in that group. If you're not in the group, or even if there are some arrangements saying that you might leave the group in the future, no relief. Halas. Actual date of you leaving the group is not relevant. And any relief given in respect of SDLT is withdrawn. That means, suppose, let's say you have been given the relief. You didn't pay the SDLT. Now it will be withdrawn. Now you have to pay that. When do you have to pay that? When the transferee company leaves the group. Let's say to you, an asset has been transferred. Now you are leaving the group. You are the transferee. I'm the transferor. You are leaving the group. Within 3 years of the transfer, while still owning the land transfer. Let's say I've given you a land when we were in a group. Now you're leaving the group. Let's say in 2 years you are leaving the group. But still you have that land that I have transferred to you. Then you have to pay that STLD that you didn't pay before. Let's summarize stamp duty land tax. Basic rules and exemptions. Payable by the purchaser on the transfer of land and property in England and Northern Ireland based on the value of the property transferred. Charged at varying rates. Up to 5% for non-residential property. It is calculated on a stepped basis. 150,000, less than 150, 0. 150,000, 250, 2%. More than 150, 5%. This are exemption. Gifts, divorce arrangements, variation of will, transfers between 75% companies. Now let us do questions before we move on to the summary of this lecture. So we have two questions. Illustration 3 and test understanding 2, where we have to calculate SDLT. A retail shop costing 140,000. So because the value is less than 150,000, we don't have to pay any SDLT. It would be nil. Coming to B, freehold office building costing 200,000. Remember, it is like we have to divide it. It is a stepped, right? So first 150,000 would be taxed as 0%. Then remaining 50,000 would be taxed at 2%. So this is the value. Okay. Coming to test understanding 2. Assuming both transactions took place in this tax year, calculate the payable and state who is liable to pay also on each transaction. Here, non-residential property was purchased for 420, then sold some non-residential land to Baith for 145. Here, first transaction, he or she is purchasing, the next one they are selling. Okay. So now, it's 420. So this 420 needs to be broken down to 150,000. First 150,000 at 0%. Okay. Then from 150 to 250, right? 100,000 at 2%. Okay. Total needs to be 420,000. The balance 170,000. It's at 5%. 8,500. So the total is 10,500. And when he says selling for 145, remember this is less than 150,000. So it's 0. So in the first one, remember the purchaser has to pay. Here, Stacey would pay SDLT. Here, Baith is the purchaser, Baith would pay, but Baith would pay 0 because the value is less than 150. So the summary of this lecture is disposal of capital asset, CGT, stamp taxes. Basic CGT rules, gives on death and gives into trust. Scope of CGT, basis of assessment, gain and loss computation, losses, CGT payable computation, and the payment dates. Very important. Please go through and start doing a question. So see you in the next lecture once again with capital gain tax. Don't forget to subscribe to my channel and thank you for watching, and all my lectures are there on the ATX playlist. Please do and watch.